All right, let's get started. I got 45 minutes. Thank you all for coming. My name is Felix Fry. I am the founder and creator of Options Geek. What is Options Geek? Options Geek is a translation of my 20-plus year career on Wall Street. It identifies, defines, and teaches how the average investor can find edge using options, just like the top 1%. Today, I'm going to teach you the option secret. But first, let's talk about edge. If I asked everyone here, what does the top 1% find edge? Most people would say the idea. And you'd be right. How and where the top 1% finds an idea is edge. But once you have an idea, once the top 1% has an idea, they have a choice to make, stock or options. The know-how, the understanding of if and when to use options is edge. And once they decide to use options, they come up into another decision, which option to use or which strategy to use. Lastly, the top 1% finds edge with their trading plan. We're going to talk about the option secret today, which is 2 and 3, and then we're going to shift to the ideas and the trading plan. How are we going to do that? I divided the presentation into 5 parts: the options question, the most important options tool, clarifying the confusion, in quotes, shift the odds in your favor, and then leveling the playing field. What I'm going to show you today is incredible. Incredible not because it's complex, I promise you. It's incredible because it's simple. It's simple and it's brand new. What I will show you today has been shown before. So if you are a beginner or an expert, I guarantee that you will learn something. I've been busy, but the industry's been busy. Over the last 20 years, the options industry has spent an enormous amount of money using the best technology, giving you the best education, and the best tools. The facts are the facts, though. Only a small percentage, a small fraction of all active investors have crossed this bridge to become options users. The industry, after all that money spent, hasn't gotten everyone over. The question is why? Why haven't they gotten everyone over to use options? We're going to answer that question today. And what you're going to find is that it plays a significant role in understanding the option secret. Let's get to work. The options question. In 1995, I graduated the University of Pennsylvania, the Wharton School. I took a flight from Philadelphia to Chicago. I was taking my first job at Swiss Bank O'Connor. And O'Connor was known for 2 things: making a lot of money in options and the best options trading program on Wall Street. It didn't take me long. For the first week I was there, I was asking a very, very simple question. I didn't get that answer on that day or during the 8-week course. I didn't get an answer for the next 16 years. And during those 16 years, I worked at Bank of America dealing every day with the top 1%. You see, when the top 1% buys or sells options, they don't go to their online trading account. What they do is they call Goldman Sachs, Morgan Stanley, or Bank of America. They call any one of these places, someone has to pick up the phone. That was me. Representing Bank of America, I traded against all these people that you see here. They were asking me, where can they buy 15 to 20,000 options at a clip, 10 times every hour? During that time, I learned a lot. But my curiosity sparked. I wanted to know why they were doing certain things. Ultimately, I left Bank of America. I went to work at Scoggin Capital Management under 2 very smart, well-known hedge fund managers and well-respected over the last 30 years. Still couldn't get an answer, although I was getting close. As I left the investment bank to join the hedge fund side, I was getting close to the answer to this simple question, simple options question. Lo and behold, I landed at a poker table in Atlantic City, of all places, in 2011. Young man asked me the question, what did I do? I said, I worked at a hedge fund. What did you do at the hedge fund? I traded options. We started talking. I was explaining to him a little bit about options, and a light bulb went off. I ran home, started writing down everything that we talked about. And I realized, amazingly, that in order to get the answer, I actually had to erase everything I knew from the get-go. And I had to start a new path to understand options in a way that nobody had ever explained it. I'm going to tell you the options question, but first let me tell you where the question pops up. No matter if you are a beginner or an expert, you will end up at the options chain. That's where you make the decisions. And when you're on that chain, you start thinking about which option do I buy? Now, if you are a seller of options, I tell you two things. One, if you're selling anything, you should understand, thank you. If you're selling anything, you should understand why people are buying options or buying anything. And two, if you wait to the end of the presentation, absorb what I'm telling you, you'll be able to find greater edge in your selling program. But we're going to tackle this because teaching someone how to sell options is incredibly easier than teaching someone how to buy options. You see, when you get to this chain, this options chain, there's tension and confusion. Where's the tension? Implicit in every trade, any trade you make, is the expectations that what? Is the belief that what? That your expectations are different than what the market is expecting. That's what a trade is. When they are different, there is opportunity. This question, which option do I buy, causes confusion. It spawns other questions. You start asking yourself, which options are cheap? What does cheap mean? Which options are expensive? How do you compare one option to the other? What do you compare? What I learned was without being able to answer those questions, and this question in particular, essentially you're guessing. And in this game, guessing leads to guaranteed losses. Guaranteed. And I'll explain that later. What's more shocking, forget about that. What's more shocking is that you can't find the answer anywhere. The options education, that the existing options education doesn't provide that answer. So that's the problem. This question leads me to ask, why can't you find an answer? Why can't you find an answer to a simple options question? So let's clarify the confusion. The options industry, the way I count it, they spent over $1 billion trying to educate the masses. They missed one class, one very important class, and maybe they glanced at it, but they didn't give enough emphasis, place enough emphasis. There are two types of options traders. Two types. There's a volatility trader and a directional leverage trader. Now I'm going to ask you, what percentage of the options users are volatility traders? What percentage of the option users are volatility traders? We're going to go from 0 to 25 all the way up to 100. Raise your hand if you think 75% to 100% are volatility traders. 75 to 100%. Raise your hand. There's no wrong answer, so everybody should raise their hand at some point. 50 to 75% are volatility traders. 50 to 75%. 25 to 50%. 25 to 50% are volatility traders. And how about 0 to 25? 0 to 25 are volatility traders. Okay. I think I talked to a few of you before the class. Volatility traders are the investment banks, hedge funds, only a few, and the market makers. Everyone else is a directional leverage trader. So here's the confusion. I say 0.1% of the population using options is a volatility trader. 0.1, and if I'm wrong, maybe it's 1%. Volatility trading is a very specific skill. It's a very specific skill. We're going to talk about what it takes because it's important to understand. There are two types of traders, the volatility trader and the directional leverage trader. We're going to answer these three questions so we fully understand what each are. What do they care about? How do they profit? And how do they choose the right option? A volatility trader cares about not so much about the direction. Not so much about the direction. They actually care about how the stock got there. See, I could be a volatility trader. I can buy calls and the stock could go straight down and I can make a lot of money. I can buy calls and the stock could go straight up and I could lose a lot of money. Because I'm not so concerned about where the stock is going. I'm concerned about how it gets there. How do I profit? I profit using this formula, which I can't show you. Too scary. But the Black-Scholes formula and the derivative of the Black-Scholes formula are the Greeks. And that's how the implied volatilities profit. They profit by capturing that movement. How do they choose the right option? Well, they're looking at the Greeks, and if they want to focus on one of the Greeks and neutralize all the other buckets, they'd have 4 choices out there. So how do they choose? In this case, they would choose 4 because they're trying to keep the Vega bucket the same or higher, and they'd neutralize all the other buckets. So when choosing an option, the volatility trader is looking at a 5-dimensional puzzle, one that fits their portfolio. Let's talk about directional leverage traders. What do they care about? Well, they care about the target stock price. They care about 3 things. 1, the direction. 2, the magnitude of the move, how much it moves. And 3, time. How long is it going to take to get there? They don't care so much about how it gets there. They care about if it gets there. They don't care so much about the Black-Scholes formula because that's not how they profit. How do they profit? They profit if they buy an option from that and pay $1 and it becomes worth $3, $4, $5 using their target stock price, time, and the choice of a call option. Which brings us to how do they choose the right option? How do they choose the right option? And that brings us back to the options chain, where everyone is confused. Volatility trading is a very specific skill. We have to understand that. And the education that's provided teaches you the gamma, the deltas, the Greeks, and focuses a lot on implied volatility. That's the way the volatility trader profits. That's an important distinction. I call the education that's offered right now this cube that'll never fit into this directional leverage hole. No matter how much money, how many billions of dollars, it will never fit. People will always be confused because that's not how they use options. So the question is why? Why does the options industry give you that education? I told you that I worked at O'Connor. O'Connor had the best education. Most of the education that's offered today, its roots come from the O'Connor education. O'Connor were volatility traders. They made a lot of money in options, but they made it trading volatility. The options education they created was for people like myself to become implied volatility traders. I was one. That's what I did at Bank of America. The Options Industry Council, the OIC, is one of the largest providers of free education online. They are supported by the OCC, who are exchanges, hedge funds, and investment banks. All those trade options and trade as volatility traders. In my book, The Options Answer, I show you proof that there is no answer to this question, which option do I buy? In fact, the industry, and I show you proof that the industry avoids the question. So to answer my question, it's either A, they don't know the answer, or B, they know the answer, but they aren't telling you. It has to be one or the other. I'm not smart enough to know that answer. So here's the problem. It's a big problem in the industry. It's $1 billion, $20 billion industry. The problem is that there's this question no one can answer. Everyone's looking at an options chain. They don't really understand how to pick or how to choose. The education doesn't describe clearly that they are not volatility traders, and most people, on average, it's about 50% thought people were volatility traders. Usually I do this several times, and I've done it several times, and most of the time it's 50 to 75%. I've showed you how each profits and what they care about. We've talked about the education and where it comes from, and most importantly, where it leads. Most importantly, where it leads. This, to me, is a problem. So now let's talk about the solution. Shift the odds in your favor is easy to say. It's very easy to say, but no one teaches you how to do it. See, when I was at that poker table, I said one sentence that changed my perspective on everything. Options are a probability game. And there's only one way to play a probability game. There is only one way to play a probability game. You either are play or not play. And the decision is going to be based on whether or not you have mathematical edge. What does that mean? Well, at a casino, we don't play. Well, at least we're not supposed to play, right? Because the odds are supposedly against us, even though they make a lot of money. But that's why they make a lot of money, because the odds are against us. We play games where the odds are in our favor. We understand this conceptually. The question is, how do we do that with options? So now I'm going to bring you a couple of games to help us understand. In a game of heads or tails, we have to decide whether we play or don't play. If the odds or the payouts to you were win $1, lose $2, I'm not going to ask you. Most people are going to know we don't play this game, right? We don't play this game. But what if I switched? What if I switched it? How many people would play this game? Win 2, lose 1. How many people would play heads or tails where you win 2 or lose 1? I see everybody nodding. We all want to play that game. We play all day. All day. The question I have is, where's the indifference point? Because we went from not playing to everybody wants to play. Not playing to everybody wants to play. So there's an indifference level. There's that place where we play, don't play. There has to be a point. I'm using a 300-year-old formula. A 300-year-old formula where the expected gains have to equal the expected losses. I'm not going to go through all the math each time, but essentially the expected gains or the probability of a positive outcome times the gain has to equal the probability of a negative outcome times the loss. What does this mean? The risk reward is balanced. It's balanced. There is no edge. Over time, no one's going to win. So in heads or tails, to solve for the blank box, we would stick in $1. $1 would balance the expected gains and the expected losses. We understand this. We understand this. Win $1, lose $1, nobody wins over time. If we stuck in $2, here's the proof. The proof is that the expected gains are greater than the expected losses, so you should play that game. Easy enough. Easy enough. That is called mathematical edge. That's where the odds are in your favor. How about this game? Pick the diamond. Play or don't play. Win $2, lose $1. Win $2, lose $1. Who's going to play this game now? You get to choose a button. Play or don't play. Or play. Don't play, I hear. I see some people thinking. I can tell. I can see your eyes. They're thinking. Well, play. Some people got some gamble, so they want to play here. 2-1. In this game, you're not supposed to play. You're not supposed to play. What's that? Win 2, lose 1. You got to find the ace. You want to play? Oh, no, I'm sorry. Find the ace of diamonds. That was good. I like that. Find the ace of diamonds. Pick the diamond. Pick the diamond. You know what? We play all day. Yeah, okay. You got me there. I'm going to stop the game after 2 rolls. If I switched it to $10, win 10, lose 1, we're going to play. Everyone's going to play. Where's the ace of diamonds? There you go. All right, good. Pick the diamond. So we went from no, yes, because I made a mistake, but no to yes. No to yes. The question is, where's the indifference level? Where's that level that is the middle, the over-under of whether we should play or not play? Well, we just go back to our formula, and we stick in $3. $3 is going to be that indifference level where you play or don't play. Meaning, if I'm going to offer you more than $3, that's a game you want to play. Less, a game you don't want to play. Just to prove it, $10 gives us $2.50 over 75 cents mathematical edge. That's why you want to play the game. Next game, find the ace. This time we play find the ace. You guys took me for the second game. See if I can get you here. The indifference level. Where's the indifference level in find the ace? We want to know where the indifference level is in find the ace. We only have a 10% chance of winning here. 10% chance of winning. So we go back to our table, our formula. And the answer, yes, $9. $9 is the indifference level. Over $9, we want to play. Under $9, it's not giving us enough. We're not winning enough when we win. Now you're going to have to choose a game. These are the odds I'm offering. Win $1, lose $1, win 4, lose 1, win 8, lose 1. Which game? You can only pick one. Which game do you want to play? Choose a game. Let's start at the top. Number 1, heads or tails? Raise your hand. Number 2, $1 win 4, okay? And number 3, $1 win 8. The first one here, well, let's look at the indifference levels. These were the indifference levels. The first one, heads or tails, has the risk-reward balance. It's balanced. Nobody's going to win over time. The bottom one, the risk is actually against us here because we're not winning enough. We are not winning enough when we win in order to have edge over time, in order to be profitable over time. $9 is greater than 8. So the room, for the most part, was right. Now, you can do this in this game, but let me just switch it here one time. How about win 1, lose 1, win 2? Now, which would you choose? 1 or 2? People start switching to 1. The answer is 1. But you just go to the simple formula. You can just do the math, and you'll see the answer is 1. So how do we do that with options? You can do that playing a simple probability game. How do we do that with options? Well, here's where we level the playing field. Here's where I'll tell you something that nobody else has ever come up with. I'm going to show you how the top 1% trade options. And it goes a little something like this. Let's start with Apple, 174.33. That's where the stock is. We have to agree on a few things. There's a distribution around the stock. We have to agree on it. Forget about that it's normal distribution, because I know the smart guys in the room will say, log normal, I get it. But there's some distribution. We have to agree. We also have to agree that it's more likely that the stock ends around 175 than it will up on the wings. We have to agree on that. It's more likely that the stock will end up around 175. Now, I chose a 1-month option. It was February 26th. I chose March 22nd options. The stock traded 174.33. I chose 175, 180, and the 185 calls. We have to agree that there is some percentage that the stock ends above 175, above 180, and above 185. We have to agree on that. Is that fair? Now I went to the Black-Scholes formula and I simply got the numbers, 47%, 25%, and 10%. Now with a keen eye, why do you think I picked those options? What? Who said that? The percentages. Why do I think, though? Even easier. It's even easier. We just played a game of 50%, 25%, and 10%, and you knew how to play that game. You chose the right game each time. So all I did was I took those games and I labeled them against these options, 175, 180, and 185. Heads or tails, pick the diamond, and find the ace. Not playing anything different, just different numbers. You're just using different numbers. We still want to figure out if we're going to play or not play. How do we do that? I'm taking you down my journey. This is the way I was thinking about it. How do we do that? Well, when we played the games, all we did was find the indifference level, right? We didn't want to guess. We wanted to find the indifference level first, and then we would make our decision. Well, how do we do that with options? How do we do that here? I focused on the 180 calls. Cost $1.33. The 180 calls. Do we want to play that game or not? Well, with a 25% probability of success, of being in the money, probability of being negative 75%, it's negative when it doesn't reach, when the stock does not reach above that strike at expiration, I'm going to lose the premium. It's going to be zero, that option. So it's $1.33. You can fill that out. The gain is $4. The gain is going to be $4. That $4 is our gain. But I got to take that gain. And I got to do what? I got to add it to the amount of premium that I paid. We paid $1.33. The market is telling us, well, you have to gain $4. That's the market's telling us that. The value of the option is $5.33. I'm going to add that to the strike, and that gets me $185.33. That's my indifference level for that strike, for that option. Some people call it the implied stock price at expiration, right? They ask me the question, what exactly is it? Well, that's the implied stock price that the market thinks it's going to hit at expiration. I called it something different. I called it the risk-reward break-even price. It's the balance of risk-reward. It is where if you are buying that option, if you think 185.33 on Apple By expiration March 22nd, on balance, there's no edge. You have no edge there. Okay? Again, how do we have edge? Well, just like in the games that we played, Apple has to be above 185.33. If it's above 185.33, that option has edge, mathematical edge, at expiration. So I thought to myself, well, I can do that on every strike. It's a simple calculation on every single strike. And that's how I started creating this new options chain, one that was going to help us find the answer, because we didn't have enough information yet. So now I can see the risk-reward break-even price on every strike. That's the market's expectations. That's the market expectations. Now remember, I told you when you looked at that board initially, there was tension because it was your expectations against the market's expectations. That's where the opportunity lies. That's what you didn't know before. You didn't know where the market's expectations was on each option. So I put an area where you can put your expectations. You could put the target stock price, your confidence level, and the date. And you can choose whatever date you want. The confidence level is important. Why? Because if we are most confident, the more confident we are, the more leverage we will want to get. Remember, options are a tool that provide leverage, trying to make $1 to 3, 4, 5. If we are very confident, I don't promote insider trading. I'm on record with that. I don't promote insider trading, but we can learn a lot from an insider trader. When they are sure of where the stock is going, which option do they buy? They buy the option that's going to give them the highest return on their money. The highest return. So, when we are fully confident about our target stock price, we will go for the most leverage. So I stuck in our expectations here, 186. My expectation was 186 and a confidence level of 80. And a pointer pops up. A pointer. Now, how did I get that pointer? I basically used that formula, and I used a confidence bar. I explain all of that in the education I provide. That board, the way it looks, wasn't appealing to me for a couple of reasons. One, if I change, and I will in a second, my expectations, that pointer is going to move. If I go from 186 to 180, pointer will move. 190, the pointer is going to move. I know from 20 years experience, I know that a lot of these options I don't care about. And I know the top 1% doesn't care about most of the board. There's a lot of information, and frankly, it's confusing to see all of it at one time. So I started thinking, why do the top 1%, or when do the top 1% buy options? If and when? Let's answer that question. So what do they look for? The first thing they look for is movement. They're buying options for movement, and specifically sized movement. It's not good enough that you know the stock is going to move. You have to know that the stock is going to move more than what the market is expecting. Again, it's about expectations. They're also looking for events, catalysts. Why? Because the event and catalyst gives the movement. It gives them the movement. They're also targeting 150 to 400. Why? Why are they doing that? Because 50% in options is no good. Is no good. You are not going to get anyone from the top 1%, the top hedge fund managers excited about an option if you can tell them that it's going to go from $1 to $1.50. They don't care. They are only trading options if it can go from $1 to 3 to 4 to 5. They'll listen. Lastly, the top 1% is buying cheap gamma. That's what they want. Now, I won't get into what cheap gamma is. Basically, gamma is leverage. That's where the stock is, where the option starts flying. The way I describe it is be like Wayne Gretzky. We're in New York, so most people should know who Wayne Gretzky is, one of the best hockey players of all time. He said a good hockey player plays where the puck is. A great hockey player plays where the puck is going to be. The top 1% doesn't buy at-the-money options. That's where the stock is. Gamma is greatest in the at-the-money options. It's greatest there. But gamma is what they want. Gamma is expensive. So they don't want to pay for the at-the-money option. They don't want to pay for the gamma there. They want to be right with their direction, and they want the stock to cross through their strike. Crossing through their strike captures the gamma, and today I pay less for the out-of-the-money option than I pay for the at-the-money. Okay? Now, how far out of the money? 25 to 45% probability being in the money. That's what they're buying. That's what the smartest investors in the world are buying. So I thought to myself, so why bother with any other option? Why not just show people the window of opportunity? This is where they buy. Only if they have edge. Only if they have edge. This is telling them, if they can find the pointer in those boxes, this is telling them that, you know what? Remember that decision between stock or options? Not every idea is an options idea. Not every idea is an options idea. You have to make that decision that it's either a stock idea or an options idea. This helps you. This is the window, and when I stick in my expectations and that pointer pops up in that window, guess what? I have an idea that provides edge. I have an idea that provides edge, and that's an options trade. That's now an options trade. Now I can move the expectations to 180 and reduce my confidence. My pointer is going to land there. What I've done on the site is have these warning signals that basically tell you if you want to end up in the opportunity, in this window of opportunity, then you would have to raise your target stock price. Well, I raise it to 184 and it gets to this level. This will tell you that it's an at-the-money option, and the at-the-money option is not what the top 1% buy. I can raise it to 184 and raise my confidence level. Here all I did was raise it from 70 to 95. Now it gets me in this window of opportunity. What you shouldn't be doing is trying to get it into the window of opportunity. You shouldn't be trying. Anybody, I can say Apple's going to 500 and that board is going to come up with an answer. That doesn't mean edge. You have to find edge in the idea. You find edge in the idea, and then you plug in your expectations, and the machine will tell you whether or not you have opportunity as an options trade. If you are beyond the window of opportunity, you can still buy that option. However, I'm simply telling you, you're being very aggressive here. Meaning, are you sure your expectations are correct? Because you know something much more than what the market knows. Again, I just moved the confidence level to show you that there are 1,000,001 ways to get wherever you want to go. This is specific to you. Each person has their own unique expectations. That's what makes a market. I'm going to let you play with this tool, and I'll show you later on how you get to this tool. That's the option secret, knowing if and when, and knowing which options to use. Now, on a side note, people have asked me all day today, what strategies? What are the best strategies? What are the strategies that the top 1% use? I can explain more later, but I will tell you that 90% of the time, 90%, the top 1% are only buying puts, buying calls, selling calls, or selling puts. That's it. 90% of the time. Very little call spreads, very little put spreads, very little butterflies, certainly not many iron condors, no matter what you hear out in that room. The top 1% is not trading iron condors. I'm on record saying that. And if you can find me one major top hedge fund, long-short hedge fund, I would be shocked. I'd have to give you a prize of something. I don't know yet, but I'd give you something. Ideas. We're going to talk about ideas. We know the option secret, but remember, the edge, part of the edge lands with the idea. There's still edge in the option, choosing the option, but the option, it's important, is a tool to leverage to magnify the returns of your idea. That's why you save options for the most confident ideas, for ideas that have movement, and then you can use the options to get the high returns. That's the idea. That's how you play the game of options when you are buying options. Selling is a different mentality and a different game. Another presentation another time. Pipeline of trading ideas. The top 1% understand the value of good trading ideas. The value of good trading ideas. They are not so concerned about the win rate. They're concerned about risk reward. They are looking for great risk reward opportunities. Win rate counts, but it's not the full equation. It is not the full equation. In options, when you are buying options, the win rate, a good win rate is 40 to 45%. That is very good, but it doesn't tell the whole story. It's only good if the amount you win, if the amount you can win on the options trade is high enough. Talk about that in a second. My ideas that I've given over the last 20 years to the top 1% include fundamental analysis, technical analysis, options analysis. I keep it simple. We are either buying calls or buying puts. I'm looking for those moments to find movement. I'm trying to show there is movement coming, and these are the reasons why. Duration, 2 weeks to 6 months. Now what I want to show you, over the last 5 months, first 50 expiring trades, this is the track record. One trade hits almost 1,600%. Number 49 and 50 look like top ticks. The point is that options, what's important about any option buying strategy is the amount you win between today and when it expires. The high point. That's what's important to recognize what that high point is. Doesn't mean you're going to hit the high point. It means you have to understand that you are hitting stocks that move. That's most important. Here's what else is good to understand. That it's likely that at expiration, you will not be at that high point. You will not be at that high point. So by definition, you're trying to hit the middle. You are trying to hit the middle. That's where the options plan comes in. Now I have a seminar, and again, I'll show it to you after where you can get it. I have a seminar where I explain a great options trading plan. Each plan is unique to you. Why? Because it involves being either aggressive or conservative at many different points. And that's going to be unique to you. There is no plan. No one out there can sell you a plan that's going to fit everyone, because some people want it to be more conservative and some more aggressive. So the plan is very important, and you're trying to extract the middle, the yellow. Here are some of the percentages. The average high here was 283%. I took out the top 5 winners because they can get skewed sometimes. You're still getting at about 191%. Win rate, using a win rate of 40% and trying to capture 150% gain when you win, stopping yourself out at 50 is the same thing as playing the game you wanted to play earlier. Win $2, lose $1. You would play that game. That game has edge. But those rates in options also have edge. It's important to understand that. Options are a probability game, so you have to think about it as a probability game. Notice not one time have I mentioned, although I mentioned the gamma just I didn't actually explain it, but I don't mention the Greeks. I didn't mention implied volatility. I've created that tool to help everyone get across this bridge. I asked you why. You know why now. Because options education is incomplete. It is incomplete. The technology, too complex, and it's missing data. You're not getting this indifference level. How are people choosing which option they should buy? It's very complicated. We went through the 4 points. I gave you the new options chain to take out all the guesswork in options. I showed you how the ideas have edge, and in the education, you will get education on the plan and everything else I described there. Where can you find that? Optionsgeek.com. Now, unfortunately, I can't charge you what I charge top 1%, unfortunately for me. However, I think my mission is more important. I'm trying to reach out to everyone. I want everyone to at least see the education, to see the tool, to play around with the tool. So with this promo code, I'll give you a free month. No obligation. Cancel at any time. Use the ideas. Jump on the education. It shouldn't take you more than a month, for sure. So get it all. If you like it, pass it along to someone. Tell someone that this is valuable. What I ask is simple. I like testimonials. I like people to tell me that, you know what, that was awesome. That was great. It keeps me going. I'm going up against a whole industry and a whole lot of education out there. But I think my education is the best. I think it's simple. I think it resonates with people, and I think it can get people across that bridge. I see a lot of these words, so feel free to use any of these words. But one of the best testimonials came from a British guy from Morgan Stanley. British guy, you know, straight out British guy, nice suit, came up to me after the class using a lot of these words, talking really fast, and ended it with, in his British accent, I can't repeat it here, but all I said to him was, thank you very much, thank you for having me. If you have any questions, please send me an email and send me a testimonial. Thank you very much. We could take some questions if you'd like. That's the formula, by the way, for the risk-reward break-even price. Any questions? Do you have a question? Go ahead.
Yes. So at one point you cited the best option to buy.
25%, 45% probability of being out of the money.
Okay.
Probability.
What does that translate to in delta?
It's close. So delta and the probability of being in the money has long been said to be equal. They're the same. It's not the same. It's mathematically not the same. It's close, depending on two things, depending on the amount of time you're using and the volatility. So
So I think I didn't understand. Did you mean out of the money or in the money? Are you talking about a 65 delta or a 45 delta?
no, in delta terms, it would be about 25 to 45. Let's just call it that. Okay, but you can get, there's a, in some brokerages do offer the probability of being in money. That's more specific. Delta has always just been an estimation of that number. Sure, no problem. Any other questions? Anything?
We can't calculate this probability ourselves, can we?
You can get it from, you can, but you got to go through the Black-Scholes. It comes right out of the Black-Scholes formula. Okay, I'll tell you what. I think, okay, if you look at this formula, look at risk-reward call equals call strike plus call premium. This is my contribution to the options industry. I think this is groundbreaking, and I think there will be more studies on this. Risk-reward of the call is equal to call strike plus call premium. What is that? We know what that is. That's the break-even level. That's just the break-even level. They give us that. That's been around for 40 years. Okay? But it's not really helpful. It just basically tells you where you get your money back. Okay? What I did is I normalized it. I normalized it using the probability of being in the money. It's the first time that's ever been done. Someone once told me, a very smart options player, says, yeah, it's too simple. It's too simple. Got very angry at me. Simple is good. Simple is good. Now, the probability, the smarter you are, you're going to understand that the probability of in the money, there's a lot of ways to get that. There's a lot of ways to get that. So I think there'll be new studies where you could stick in the Monte Carlo probabilities. You could stick in a trinomial probability tree. The mathematicians can jump on this and come up with their own conclusions, come up with their own way. Go ahead.
Just a clarification, probability in the money at expiration or?
At expiration. So what happens is, so that's the next question. The next question that most people have is, but you're just talking about expiration. What happens in the middle? Very true. What I've shown you is how to buy options in the most conservative way. Because as the stock goes in the money, it is true. If it happens early on, if it happens early, prior to expiration, there will be some time value left. Some time value. That's good. I call it a bonus. If you can get near your target stock price and that option is going up, that time value will help you. So if the stock was, if you needed it to go to $5.33 and Apple went to 182, that option might be worth about $5.33 at that point, even though it didn't get to 185.33.
So this is for long position. If you go other way around, you put
Short.
then that formula will be opposite, right?
If you just, this is the risk, you're going to look at the number. So that number is over, under. So what basically it's telling you, and this is the beauty about this is now you will understand how expensive options are. First, you have to find opportunity. Second, as a seller, you might think, well, that's easy. However, there are greater risks with selling. And that's, again, it's a whole nother mindset to sell. But no, the number won't change. The number is always the same. The risk-reward put and the risk-reward call is always the same. It's how you use it. With a call, you want it above. If you're selling, you want your target price below. Okay? It's sort of like playing heads or tails or all those games. You want it either high or low. You want to be the house, right? Being the seller is the house, okay? Or you want to be the person who's actually thinks he knows where that is. The top 1%, they buy. Okay. The top 1% buy, except like usually it was me to sell it. But here's the difference. Remember, hold on one second, hold on. I was trading volatility. They were trading direction. We can coexist. In the options world, I can make money and you can make money. So if someone buys calls and the stock goes straight up, it depends on how it went up. The call buyer will make money, but I could also make money because I'm trading volatility. Okay, it's a different game. It's a whole different game. Okay, so the top 1% generally buy. Now, Warren Buffett is one of the top 1%. He's a huge seller of premium. But 90% of the top 1% buy. Go ahead. Yes, you. Sorry.
Are you guys to hold the options to the maturity or do you trade them before the options
Yeah, so my idea is essentially that I've showed you the highest percentage. What I teach is how to get out. That's part of the plan. Part of the plan is how to get in and how to get out. Okay, so what I teach is how to get out in layers, but that becomes your decision. I generally teach 100%, you get out of a third, 175, you get out of a third, 250, you get out of a third. That gives you 175 if you hit 250. Some people want the 100, they're willing to take a little bit more risk and they'll go to 200 and 350. It just depends on what you're trying to reach. Is that fair? During the life of the contract, during the life. So after day one, if the option goes from $1 to $2, I take off a third.
But if you want personal trading, how often do you do it?
Most of the time. I'm usually, yes, it's a third, a third, a third. And usually it happens before expiration.
The other way. About if it goes against you.
Goes against you, stop at around 50% or 60%. Again, it could be from 40 to 60. Can't be 20. In options, it cannot be 20. You buy something for $1.20, it hits $1 in 8 minutes. Okay, it's just not, that's why you buy something for $1, 1/3, it gets down to $1, you can buy it the other third. It gets down to 80 cents, 1/3. Now you have $1, your stop loss is 50% of that is 50 cents. Hits 50 cents, it's highly likely. Once you've lost 50% of the trade, it becomes highly likely that you can make, remember, you started at $1. You're trying to make 300%. Okay? So you want that dollar, or 200%. You want that dollar to go to $3. That's 200%. It's not bad. When it goes down to 50 cents, you still need it to go up to $3. That becomes what? 500%, 250 on 50 cents. Now you're looking at a 500%. You're not going to get 500% all the time. This is not going to happen. So that's why the biggest guys on the board, they're moving out. It's not working. At some point, they just move out. Or they might roll down. When they roll down, it shows a little bit of confidence. It shows that they're putting more money into work here. They have the answer. It's not dissimilar. Some of the stuff that I talk about is not dissimilar than what Nigerian is saying. When I've traded against the top 1%, when they have the answer, they keep coming back. They know the answer. Right? They know the answer. They're smart enough to know the answer. They have guys all over the place. They know the answer. They have clickers on a Chinese boat, and they're seeing all the people going to Macau. They know the answer. Okay? They know the answer. Macau's doing well. They might be even taking the pictures of people's faces coming back. Everybody's sad. They're buying Las Vegas stocks in Macau. Okay? Trust me. LVS or whatever. Las Vegas Sands. Go ahead. Next. Go right here. Quickly.
What's the average time you close your position, like for the first 2/3, because you still have to decay with the theta.
Yeah, I don't worry so much about Greeks. I worry about my target stock price. If it's going to hit my target stock price, the Greeks don't matter. Remember I said that. If it hits your target stock price, the Greeks don't matter. I promise you that. Okay? Because if it hits your target stock price, the Greeks are going to be very small. The time value of the option will be very small, and it's a bonus to you.
So what's the average time you close your position?
It depends, but I would say if I have a 2-month option, within a month it's almost out. Right, you're looking for a very specific date, a very specific movement, whether it's technical analysis, whether it's fundamental, like an earnings play. Some people ask, do you play earnings? Sometimes. The top 1% are always playing earnings. They would come to me right before earnings, an hour before. Why? They might know the answer, and they want to leverage up 1 hour before the answer is going to pop up. I did, yes, and to answer your question, I traded against Raj Rajaratnam. It was difficult, incredibly difficult. He had everything. So how much time? I could tell you great stories about those trading days. Great stories, like phenomenal. I'll save it over there. I'm at 323 if you want to hear some of the stories. Go ahead.
Are you generally scanning for high volume?
No, high volume? High vol. No, high volume. I do look for, part of what I look for is volume. I'm looking for volume. But I look at trades, I call them sharks. A shark has a DNA. I spent 20 years following these guys, these sharks. I know. You can take all the experts, put them in a room, 100 trades. Show them 100 trades. All those experts are going to come up with a different 5 options. Okay? Why? Some are going to think one, some are going to think the other. I would put myself up against, I wish there was a competition. I'm looking for a very specific thing. I do teach a lot of it there in the education, but very specific. Very specific. It has a DNA, and I describe it from the beginning to the end. I do look for open interest, yes, it's all through the education. Essentially, I'm looking for opening trades, opening buyer. He's interested right now. If I see a trade, I see something trade and the open interest is very high in that option, I don't know if he's closing out or he's out of the position. I want opening trades. I want to see when they're opening.
How do you know? It's 2 months out, right? 2 months.
2 weeks to 6 months. 2 weeks to 6 months.
Is there an average price of the you pay?
No, so that's another good question. So price shouldn't matter of the premium. Price should never matter. Some people say, I only buy options under $1. It shouldn't matter. Options, because of the Black-Scholes formula, options, it's a percentage game. It's a percentage. So if you can buy a $1 option and you can buy one of those for $100, or you can buy 10 of those for $1,000, or you can buy one option of a $10, it's still $10. Okay? It's still $10. You're not trying to game the system by buying more. It doesn't work. That's a big myth, and that's a big mistake by a lot of new investors. More questions? I'm trying to average 175. 100, 175, 250. Which sometimes you get lucky and it gaps up so you can catch a bigger move. Many times what you find it goes to 100. I showed you that chart. It goes to 100, 120, and then goes to 0. But you're trying to get out of that. You're trying to stop yourself at the stop. If you hit that first marker of 100 and you take 1/3 and you keep your stop, you can't lose. You won't lose on that trade.
You're not worrying about the Greeks. You're worrying about the stock.
I don't care about the Greeks. The Greeks don't matter.
Stock targets.
Stock targets, risk reward. That's what matters.
You're saying wait for layperson to see if it's opening trade or...
Yes. There are scanners. It takes a lot. What you might find is a lot of these positions, there's how many millions of trades happen a day. If you use these scanners, you're going to get 50 different trades. So now you got to scan through 50 different trades to filter. I don't really go through too much in detail because that's proprietary to me. That's where I come up with my ideas. I basically can take 80,000 trades a day that are block trades, called block trades, and I can narrow it down to 5. Makes my life easier. And then I'm trying to choose between that 5. I'm trying to look, and then I start looking at very specific things.
How much is your course?
Great question. It's free right now, but the course is $225 a month, or with an annual subscription, $2,000, which makes it $169. I'm trying to make it easy. So it's free for the first month, and I got to show you. I know I got to make you money. That's it. That's the elephant in the room. The only reason you're going to stay if I make you money. Period. No, I give trades 3 to 5 ideas a week. 3 to 5 trade. Those trade ideas, 3 to 5 of them a week.
Are they for calls or puts?
No, I try to do both, calls and puts. You don't want to have a portfolio, even if they look great, of all calls, because December happens and they're all wiped out. If you do puts and calls and December happens, one is going to go to 0 and one will likely go to 400 or 500%. Okay, so you want to balance. You don't want to be in all FANG stocks. You don't want to be in all, one sector. You want to diversify and play puts, calls, and you're trying to make sure that, whenever I see, if my ideas, in the last 2.5 months, I see that my ideas, there's more calls. There's more, the big guys are coming in with more calls. I'm forcing myself to find puts, right? Because you can't just give everyone calls. It's, if the big guys are wrong too, if something happens, the market goes down, that's it, it's over. Okay, so you got to have that balance. Question? I'm sorry? Do I look at weekly options? Weekly options, maybe in the trades that I offer, 1 out of 20, it's got to be a very special situation for a weekly option. Right? The options are usually the 1% is not buying daily or weekly. They're usually not. Although I can tell you a story. The guy came in at literally 3:45 for DNA call options, and right after hours, Genentech announced a major decision, and I didn't. The best trade I did was a trade I didn't do. So the guy comes in and buys it with a 3:45 on a Friday, and then Genentech makes an announcement. I would have lost $15 million. Screaming at the sales guy calling the account, telling them every word in the book. Like, you can't do that. You're trying to kill me. You can't do that. So usually the top 1% is not doing that weekly op. They're usually not. They're giving themselves time. 2 weeks is probably the best. You're looking a little bit further. KHC, They were buying those options a month before. KHC, Warren Buffett's name, right? Stock gets killed. Heinz jumps on the radar. Why? Because they're coming after it. They're coming after it in a big way. Why? You know, the SEC has 100 people investigating companies. How much do they make there? Probably not that much, okay, relative to a big, bad hedge fund guy. You get somebody to just say, hey, you know what? Maybe you should buy puts in. I'm not saying what people did, how they did it, but nobody ever buys that many puts in KHC. Nobody. I don't think ever. Okay, I don't think ever. So when I saw that, someone knows something. It's worth a shot here. This is a good one. It's worth a shot. Nobody has ever bought puts like that in KHC. It just doesn't happen. So give you a little insight of what I'm looking. I have long history of knowing, okay, this looks odd, this doesn't look odd. This is really odd, doesn't look odd. But then we're also taking technicals. What you're trying to figure out what they're looking at. Why are they buying that option? That's the answer, right? I'm calling friends in the business, calling my friends at Goldman, at Deutsche. Hey, what are you seeing? What's going on here? Oh, the guy at Goldman, but Goldman Sachs putting up 15,000 KHC. I call my friend at Goldman Sachs. What's going on with this KHC? Oh man, this is like, that's all I need to hear. Thanks a lot, Glenn. He knows who the buyer is. There's a buyer. He knows. When I worked on that side, guess what? When Carl Icahn's coming in, when, Steve Cohen's coming in, and they're all buying bank stocks, they're all buying calls and bank stocks, and they're hurrying up, and they want to buy calls and bank stocks, which way are the bank stocks going? They're going up. It's not rocket science. Now, you got to understand where they're coming in and how 3,000, 5,000, 10,000, 15,000 options, those should raise eyebrows. But it doesn't tell the full story. Next question. One more. You're using up a lot of time. Over there, 323. I'm in room 323. They're going to kick me out. The piano's going to play. Yes, you can ask me many questions. 323. Or come out. Yeah, booth 323. Thank you.